In this video, we will walk through the essentials of capital gains tax in Denmark, with a focus on what investors need to know to make informed, compliant decisions. Our objective is not to provide personal tax advice, but to give you a clear, structured overview of the rules and practical implications so you can engage more effectively with your tax advisor or financial planner. We will begin by clarifying what capital gains tax is in the Danish context and then move through how it applies to individuals, which asset types are most relevant, how gains are calculated and taxed, and a few planning considerations that responsible investors typically assess. In Denmark, capital gains tax is primarily a tax on the profit you realize when you dispose of certain assets, such as shares, investment funds, property that is not your primary home, and some financial instruments. From an individual investor perspective, the most common area of focus is taxation on gains from shares and investment funds, both Danish and foreign. Denmark distinguishes between gains on shares and gains on other types of investments, and the way your gains are taxed depends not only on the type of asset but also on your holding structure, your total income level, and whether you are fully tax resident in Denmark. For Danish tax residents, global investment income is generally taxable in Denmark, subject to double taxation treaties, meaning that even if you invest abroad, the Danish rules can still apply and may require reporting to the Danish tax agency. When we focus on listed shares held by private individuals, capital gains are typically treated as share income. Gains are calculated as the sales price minus the acquisition cost, including transaction costs, and losses can, under certain conditions, be used to offset gains on other shares. The share income is taxed at progressive rates, with a lower rate applied up to a certain annual threshold and a higher rate above that threshold. The exact thresholds are adjusted periodically, so investors should always verify the current figures with the tax authorities or a professional advisor before making decisions based on specific numbers. For unlisted shares and more complex instruments, the rules can differ, and the tax treatment may be less straightforward, making professional guidance particularly important if you hold shares in private companies, startups, or employee stock programs. Investment funds require special attention because Denmark distinguishes between equity-based funds and bond-based or mixed funds, and between funds that are accumulation-based versus distribution-based. The classification of the fund can significantly affect whether gains and returns are taxed as share income or as capital income, and whether taxation occurs on realization, when you sell the units, or on an ongoing mark-to-market basis, even if you do not sell. Many investors underestimate how this classification can alter their effective tax rate and cash flow, especially when holding foreign funds that do not have Danish tax status aligned with local rules. When it comes to real estate, Denmark has a well-known exemption for capital gains on the sale of your primary residence, provided certain conditions are met, including actual use as your main home and compliance with size and usage criteria. However, gains on investment properties, such as rental apartments, vacation homes not qualifying under the exemption, or commercial properties, are generally taxable. The calculation for real estate gains can involve acquisition and improvement costs, and in some circumstances, historical valuation rules, which can be quite technical. Investors typically need detailed documentation on purchase price, improvement costs, and selling expenses to determine the correct taxable gain. A key operational question for investors is when tax is triggered. For most capital assets, Denmark applies a realization principle, meaning tax becomes due when you sell the asset or otherwise dispose of it. However, as mentioned, some fund types are taxed on an annual basis on unrealized gains under mark-to-market rules. This can result in tax being due even in years when you have not sold the asset, which, in turn, impacts your liquidity planning and may influence your choice of investment products. Timing of realization can matter as well. Since share income is progressive, realizing a very large gain in a single year may push you into a higher marginal rate, whereas spreading realizations over several tax years, when commercially reasonable and compliant, can smooth your tax burden. It is important, though, that any timing decisions are grounded in genuine investment logic, not solely in tax considerations, as Danish authorities, in line with international practice, are attentive to artificial arrangements whose main purpose is tax avoidance. For residents with cross-border portfolios, double taxation treaties between Denmark and other countries play a central role. If you are taxed on a gain abroad, Denmark may grant relief through a credit mechanism, but this is subject to documentation and specific treaty provisions. The result is that optimal structuring often requires an integrated view of both Danish rules and foreign regimes, particularly if you invest through foreign brokers, hold foreign property, or participate in international share programs. From an administrative standpoint, Danish investors are expected to report their capital gains accurately in their annual tax return. Danish banks and intermediaries often report directly to the tax authorities, which simplifies compliance for domestic assets, but foreign accounts, foreign brokers, and certain complex instruments may not be fully pre-populated on your tax statement. In practice, this means you should maintain careful records of all trades, including dates, quantities, prices, and associated costs. Failure to report gains correctly can result in retroactive taxation, interest, and penalties. On the planning side, responsible investors usually focus on a few core themes. First, asset location, which assets you hold in which type of account or wrapper. Denmark, for example, offers specific investment account types, such as share savings accounts with particular tax rules and limits, which may provide administrative and, in some cases, modest tax advantages for certain profiles. Second, diversification not just by asset class and geography, but also by tax treatment, so that your overall portfolio is resilient not only in market terms but also in terms of after-tax outcomes. Third, horizon and liquidity, recognizing that certain tax rules, like annual mark-to-market taxation on some funds, can affect cash flow and should be factored into your planning if you rely on your portfolio for ongoing income. Finally, staying informed about regulatory and tax changes is essential, as Danish tax law evolves and can affect the relative attractiveness of different instruments or structures over time. To conclude, capital gains tax in Denmark is a central dimension of investing, influencing net returns, risk management, and long-term wealth planning. Understanding how the rules apply to your shares, funds, and property holdings is critical, particularly if you are a Danish tax resident with international investments. While this overview provides a high-level framework, the right course of action will always depend on your specific situation, including your residency status, asset mix, and investment objectives. Before making significant investment or divestment decisions, it is prudent to consult a qualified tax advisor who is familiar with both Danish regulation and, where relevant, cross-border issues. By combining a solid grasp of the Danish capital gains framework with tailored professional advice, you can make more confident, well-informed decisions and support the long-term resilience of your investment strategy.